Right, you're live.
Hi guys, it's Steve O'Hare from Signal Centre, and today we're doing one of our first live webinars. We're streaming live on YouTube, and we're going to talk about, well, I'm going to talk about some parts of our advanced training education. Just get my camera looking good. I'm talking about major reversal patterns. So some of you may understand this or know about reversal patterns, but I think it's quite a good thing to understand. And I'm going to first of all introduce myself. I've been working in the markets for over 30 years. I started off in the Baltic Exchange doing trading grain futures, moved on to the Financial Futures Exchange, the open outcry markets, which was great fun back in the 90s, and then trading for myself and analysing markets since then. Started with PIA first, which is now Signal Centre, in 2012. And we produce intraday trade ideas across multiple markets, but we're also working hard on our education side of things, trying to help people learn more about trading, understand more about what they're doing, so that gives them more insight into how markets work. So major reversal patterns are very important to understand these, and major reversals can happen both ways, both in an uptrending market and a downtrending market. So bear that in mind as we move through the slides. I've got Joe in the background. He's going to be answering questions that you may pose, and if we can answer him during this setup, then, or during this live presentation, then I'll try and do so at the end. So the thing we've got to think about, for a major reversal pattern to happen or to occur, first of all, you have to have a major trend. Now, the bigger the trend, the better when it comes to reversal patterns. So obviously the trend is your friend. That's a well-known saying, and something that people should understand when they're trading or investing in markets, no matter what it is, stocks, shares, financial futures, even currency markets. Now, major reversal patterns have different characteristics, but and there's different types of reversal patterns, but the characteristics are pretty similar, and we're going to go through them and talk about them in more detail. I'm going to focus on one today in particular, but I'll get to that in a second. So, as I said, the prior the trend, the bigger, the better, and when that trend actually breaks eventually, whether it's an uptrend or downtrend, that's the first sign of a potential reversal. But that's not a reversal. That's just a change of trend. So normally what you would do, you go from an uptrend to a sideways trend to a downtrend. Very infrequently, you'll go from an uptrend straight into a downtrend. So here's the uptrend, and we know that markets don't just go in a straight line. They do have different types of impulsive and corrective waves, and the first sign of a potential reversal is when the trend line breaks. So you can join the lows of a chart price or the highs of a chart price, and when that trend line breaks, that's the first sign that a reversal could be occurring. Now, the main characteristics of all these is we've got to understand that tops are shorter and more volatile, bottoms have smaller ranges and take longer to play out. Declines occur faster than rallies, as we've seen over recent days in particular. And also there's always a volume confirmation can be quite key in really finding the best reversal patterns. Here we have the reversal pattern itself. Now let's go from the major ones that we are going to be covering over the coming broadcasts. Head and shoulders reversal is one of my favorites, and you can also get an inverse head and shoulders formation. And we can I'll describe the head and shoulders formation pattern, but also think about it the other way around. So a head and shoulders reversal pattern happens in an uptrending market. An inverse head and shoulders would happen in a downtrending market, but the same characteristics are the same for both these patterns. We also get double tops and double bottoms, and also triple tops and triple bottoms. They're quite infrequent and very rare. Normally triple tops, triple bottoms will turn into head and shoulders formations, or actually be a head and shoulders formation which is unequal. Also, we have sources and spikes. So here's just an example of a head and shoulders reversal formation. you can see the market is trending upwards, has a pullback, a second spike higher. So the left shoulder's been formed, a pullback, and now we can draw a neckline, the final shoulder, and then the sell-off. The inverse head and shoulders formation is the same in reverse, a downward trending market, left shoulder formed, a spike higher, the head then formed, another spike higher, back to the right shoulder, and then eventually we break the neckline and prices move higher. I've got some volume indicators on here, but I'll go into a bit more detail on those in a second. Double tops and double bottoms, where you have just 2 points that you line up. Price action posts a low, and then a few days later, a few weeks later, even months later, posts a low around the same price. Doesn't have to be exactly, can be you know, a few percentage points either side. And then in between that, we formed a high. This is a double bottom. This is in this example. That high then becomes quite an important figure, because if we actually do break that high eventually, then that we should basically look for a measured move equal to the distance between the bottom and the neckline, and we extend that higher, and the double bottom targeted price would be equal to that. Triple tops, very infrequent indeed. As you can see, they have the rally higher, dip down, higher. Normally this would be a slightly higher and form a head, come back down. Here's the neckline and a break of the neckline, and you can see the extended move lower. So pretty comprehensive and pretty good patterns. They do have a lot of success. Now, I'm quite a visual learner, and I always like to use graphics and images to remember things. I hope maybe you're the same. And if I show you the actual head and shoulders formation again, the reversal, if I put my face in it, it probably doesn't do it any justice. Remember, you have to have this obvious shoulder down to the neckline, top of the head, down to the neckline, and back up to the right shoulder. I haven't quite got the shoulders for it, but I've got a great picture here, which I picked up, that does. You see the real spike higher into the left shoulder, down to the neckline, the head, down to the neckline again, back to the right shoulder, and then the big sell-off. Looks a little bit prettier than me. Right, let's get down to the analysis. The analysis itself, as I say, we're looking at the head and shoulders formation and really think about this prior uptrend. Head and shoulders formations can occur, or this type of pattern can occur in markets that are sideways. They're not quite as effective, because the whole point of it is in this build up or this impulsive wave higher, there's long positions that are being built up. When the reversal formation takes place, which would be a break of the neckline, that's when you get all this build up of longs here will be panicking out and stopping themselves out, or taking profit even if they've got in a little bit lower down. So the left shoulder, we can see there's higher volume. These are volume bars at the bottom. We can see a higher volume before we get this dip down. Obviously on the rally to the head, a couple of days of spike in volumes, but it's still overall, the average volume is less, and you can see it dropping even further down here. The dip to the previous reaction low occurs on really low volume. And the final rally, you can see we're right down here. This spike higher coincides with the actual sell-off and the breakthrough of the neckline, which obviously volume will then pick up after this formation has taken place. Remember, one of the key important things about a reversal, head and shoulders reversal, is the close below the neckline confirms the formation. Not before that is it a clean head and shoulders reversal formation. Also remember, on a lot of head and shoulders formations, you do get a throwback. I'll explain a little bit more about that in a minute. But here's just a graphical term where you see the rally higher on decent sized volume, the pullback, and the rally to the head, to the top of the head, is on less volume, and volume drops off again on this last rally. Especially, this shows that there's even more lack of interest in this rally. And then we draw the neckline in, and then we know where we're looking for the market to break lower, and the volume will spike higher as this level breaks. Now, I'm going to show you 3 different ways of trading the reversal pattern. The first one I like to call jumping in at the deep end. This is what a lot of people get carried away with. They see these sort of formations taking shape and they think, right, okay, let's get in early. So what you will do, obviously, if you have the volume bars as well to back this formation up, this will give you an even better indication. So if you see that you're halfway through this formation taking shape, you think, right, okay, the market's rallying into the right shoulder. This is what I think. And this is where you're looking to sell into. This is jumping in at the deep end. It's quite a dangerous way of trading the formation because there is less chance of it happening. So diving in, looking at maybe you'll look for a reversal from the this rally. So Fibonacci levels could come in, which we'll cover in other webinars. But we're really looking for the right shoulder to come somewhere in line with the left shoulder. But obviously the volume should be lower as well. And then we pick the point to sell it at. And if you're trying to preempt this move, like by jumping in the deep end, you'll have to think about where to place your stop. Now, the good thing about the head and shoulders formation is it actually does tell you where the good chances are of the measured move target appearing. So when the formation does take place, we measure from, well, we can know where the stop placement initially is if we're jumping in at the deep end. That'll be a break of the head. That'll mean the formation hasn't taken place. But we'll take the measurement from the top of the head to the neckline and we extend it down from where that break takes place. So if we're estimating that the break is going to take place here, we can put the measured move in and we can basically have a good idea where our target's going to be. So we've got to make sure our risk reward is good in this instance. The risk could be whatever the measurement is here, 50 pips, because we know the target is going to be at least 100 pips. And you're trying to get in early so you could even make more on this formation. When the market actually finally breaks through the neckline, you can actually bring the stop in as well. You can manage the stop because the neckline or the trend line, which was previously support, now becomes resistance. So again, think about that. You can bring your stop in to either to the top of the shoulder, or you could actually bring it down to the neckline. A break of the trend would cancel out the whole formation itself. Breaking the neck, another, it doesn't sound too hospitable, but this is a little bit more of a way of trading the pattern. It's a little bit more in line with how you should trade it. So this is for the less aggressive traders out there. You would sell on a break or a close below the neckline. That would be the confirmation, a break or a close below there. That's the place to get in. Now, in this instance, you can have your stop placed just above. You know that your targeted measure move is going to be down to this level. So you can place your stop at the right shoulder. Once you actually break through the neckline, in this instance, we're showing what tends to happen is a throwback. And when we do get that break through the neckline, we can again adjust the stop. So you're managing your risk reward, managing your money, and you're on side as well. So again, the throwback could occur, and then you get the break higher, and your stop is there. Then you know you've lost more money, lost less money, and then we get the final move lower. Now, the throwback is definitely the third and final way of trading this reversal formation. Now, the throwback tends to happen in slightly weaker head and shoulders formations. When you get a strong head and shoulders formation, the move lower is really strong, and you don't get that real decent throwback to test the neckline because it's so overextended on the top side. But you know, if you are fortunate enough to have this formation all set up, ready to go, then this is a real decent risk reward way of trading the formation, and you sell it on the pullback or the throwback to the neckline. So that's pretty key. You sell it at the neckline. Again, you know your stop is above the right shoulder, and as soon as you know the measured move, you know where your target is, and as soon as we get a rejection of this neckline, you can adjust your stop to the trend line itself. So you're very, very quickly, you're almost got a free trade idea on. And that's the key to it. It's really cutting the losses and running the profit. If you can do that on most of your trades, you'll be doing pretty well. Here's a little throwback to where I started and where I am now. And if there's any questions, hopefully we can answer them now. Joe, got any questions on this?
No, a minute, mate. But if people want to get in contact with us, then obviously they can reach out to us via Telegram or on Skype. We'll be more than happy to answer any questions regarding this or anything else.
Lovely. Okay. Yeah, look forward to hearing from you. I think Joe's running a session shortly. What are you going to do
this afternoon? About 12:30, I will be doing a quick webinar on setting up your charts. Some basic tips to help you get ahead.
Excellent.
Cool. Right. Thanks for that, Steve.
All right, mate. Cheers.
Speak to you soon. Bye.
Bye.